2022 is a more complex year, so I can't assign as high a probability to it. My perspective is in a world riddled with debt and overwhelmed by debt, if you raise prices on people, they will consume less. So my view is the opposite of everybody else's view currently. My view is that growth slows dramatically based on both the central bank balance sheet tapering and the higher prices of input costs like electricity, those kind of things, and also gasoline for cars. Those kind of things are fixed costs. And if you raise the fixed costs in people without raising wages as much, you end up with less demand. Or its potential is more borrowing. That's the only way. You either consume less or borrow more. It doesn't look like the banking system really wants to lend in that way, and household balance sheets are already, have an excessive amount of debt. So I think the balance of probabilities is a slower year, which is not what people expect. A slower year would tend to see a reduction in the rate of inflation, a reduction in bond yields, and a probable return of expansion of the central bank balance sheets, which is somewhat typical after almost every single recession. The central banks tend to wait for the economy to truly stabilize. And that process usually takes about 2 years of further rate cuts as the stimulus rolls off. And then the economy comes down to a trend rate of growth, which is too low. They stimulate again, it drifts down, they stimulate again, and eventually you find the equilibrium level of the trend rate of growth, which I think is much lower than people expect.
Why do you think you're a contrarian from this perspective?
Because most people see what's in front of their eyes and not what lies into the future. So you need to look at the kind of probabilistic trees of, okay, what could happen? There are no certainties. None of us know, but where do the probabilities align themselves? Most people look with inflation up now, therefore inflation, therefore wages will go up. And and therefore the Fed needs to tighten. That's the general how the market tends to think. The macro game is all about living in the future and looking backwards at the probabilities to say, what is the most likely outcome from here? And is there opportunity to invest accordingly?
So you think that the inflation rate of like almost 7% that we've seen in the US will go down?
Correct. Either mathematically it's likely to go down. If you also just step back and say, well, what has happened to the price of oil? It's been coming off again. Copper hasn't gone up for some time. Lumber prices, well, they've come down. So what we're left with is natural gas in Europe is still very strong.
Yep.
Um, some of the agricultural complex is still strong because of supply issues. Those are the real issues here. I think we're already starting to see mitigation within housing prices and stuff like that, where prices again destroyed demand.
So from a selfish, let's say, crypto perspective, what should we want from 2022?
From what we want and what we get is always two different things.
Obviously.
Um, the best backdrop to crypto would be further economic weakness and the marginal propensity for the balance sheets of the central banks to increase. That would be positive crypto and would certainly extend the cycle further than people imagine. And that's potentially on offer here, but it's far from a certainty.
So now that we moved slowly into the crypto land, why have you become interested in Bitcoin and how did it happen?
So my story was a macro story. I had been observing since the mid 2000s the increase in debt that was going on in the world. By 1997-98, the debt crisis had become a sovereign crisis in Asia and also a leverage crisis within the West with the banks and long-term capital management. And I had been observing that, and that's when I started to realize the deflationary trends that were going on because of this, and that debt crises tend to roll from one place to another until it works itself through. what was surprising was 2000 didn't end up being a debt crisis, but it became an aggressive use of interest rates, much like 97 was. And that had stopped a debt crisis forming, but we had the popping of the bubble of the equity market at the time. But again, debt didn't go away. Speculation moved from the equity market, where it was hard to get leverage, to the property market, where it was easy to get leverage. So leverage exploded again, but this time at household level and at banking level. 2008 comes along, and there was the expected debt crisis that many of us knew was coming. But it was too late to allow it all to burn, the Austrian economic route that people wish but don't actually want. And that came along, and the answer now was not only cut interest rates to zero, but now to stop printing money as well. So, okay, this was a new development. We didn't really know what it meant at the time, but what it did do was increase leverage yet again. But the debt crisis hadn't gone away. The next one was Europe, 2012. I was there, and I had to buy a generator and buy food, tinned food, in case we lost the banking system. It was that close. Cyprus had lost its banking system. Greece had lost most of its banking system, and I was in Spain at the time. So eventually it passed with Mario Draghi's moment and yet more printing of money. And at that point, I thought, okay, nothing has been resolved yet again. How do we protect ourselves? So I thought, okay, maybe we need to set up a bank that holds deposits in US treasuries and nothing else. No rehypothecation, no lending, no nothing. Basically a receptacle to hold your savings that couldn't be taken away from you. So I went around the world with a few family offices trying to set up that, and it was hard. Trying to set up a bank is not easy. And so at that point, a friend of mine tapped me on the shoulder back in 2012 and said, have you looked at Bitcoin? And it was Bitcoin that suddenly it was like, oh, okay, I get this. It's this scarce asset that has properties that are similar to gold. But this blockchain technology means we can record everything. So if the system blows up, you know who owns what.
Was it Dan Moorhead?
No, this was a guy called Emil Woods, who is very much in the background. He was a partner with Chad Cascarilla, who's founded Paxos. Emil's very much in the background, but has been a thought leader in this space and a prolific investor in this space for a very long time. He got, me into it, and then eventually via that, Mark Yusko, Dan Tapiero, all of this. So Emil was our ground zero for all of this.
The grandfather.
Yeah. So that's how I got into it. I then wrote the first macro paper on a valuation for Bitcoin back in 2013, where I said, well, if it is some sort of digital gold, which basically the white paper refers to, and the work around it at the time, I thought, okay, let's have a look at the above ground supply of gold, the known amounts of gold, and back Bitcoin into it, which is basically a very rudimentary stock to flow model. Mm-hmm. And I got the valuation of Bitcoin at $1 million with gold at $1,300. So I'm like, okay, it's trading at $200. This is the best risk reward. And I said, assume I'm the idiot, which I always do. Maybe I'm wrong, and I'm 90% wrong. So its valuation is $100,000. It's still the best reward I've ever seen.